And now we came to the final and essential session of the evening, which is surely cannot be missed, to the amendments in indirect tax, GST and Customs. We have with us A. Jatin Christopher, partner at JCSS Associates. Mr. Christopher is a multidisciplinary professional, chartered accountant, cost accountant, and law graduate who has specialized in indirect tax laws since qualifying in 1996. An accomplished author and resource person for the ICAI. He has contributed extensively to post-qualification programs on indirect taxation and supported the development of various ICAI publication and research materials. Mr. Christopher also collaborates with government bodies to conduct training for practitioners, businesses, and tax officials. Since 2000, he has practiced at JCSS, a full-time service firm with pan-India presence. Welcome, sir. Good
Thank you.
evening.
Thank you. Good evening.
How are you?
Very well, thank you.
The stage is all yours now.
Thank you very much. Good evening, friends. I realize that being a marathon session, everyone's glued to their screens to learn from experts who have addressed participants all day on various aspects. And as we come to the topic of customs law and GST amendments, there are some important amendments that have very immediate relevance to taxpayers' grievances and ease of doing business. We'll jump straight into some of the provisions in customs law before we spend time on GST. I know everyone's keen to look at the amendments in the GST law, but there are some important amendments in customs and central excise law which we need to touch upon. One significant thing that amendment that we see proposed in this finance bill is the introduction of Section 18A, which provides for importers and exporters to amend assessed documents or duty paid on self-assessment basis. This is so significant that I picked to talk about this amendment proposed first when we talk about customs law, because this is to supplement the provision in Section 149, where historically, I mean, this section has stood in the statute book from 1962. And today we have an amendment proposed to bring something that 149 has not been able to accomplish. Here is a provision that is proposed where the importer or the exporter can voluntarily revise and amend the assessment that was made in the past, whether it results in a higher duty outgo or a lesser duty outgo. Section 18A proposes to permit the importer or the exporter to put forward a correction in the duty paid and assessed already. This is so significant because there could be several instances where after the fact, after the goods have been imported, after duties have been discharged or exemption claimed, there are certain requirements for which taxpayer might need to go back and revisit the assessment done in customs. To give you an example, Rule 9610 had wreaked havoc as far as exporters are concerned, where they had availed even a very nominal amount of concession in import assessment, whether it is for one part of the year or for the whole year or for a year much earlier to the year in which exports were done, until 9610 came to be completely done away with in the previous budget. What we find that taxpayers were willing to return the duty concession they had claimed earlier. The only remedy available was to make amendment under 149 and make an application under 149 to amend the import assessment to be entitled to export refund, which was restricted due to 9610. Now, here is a provision, just one instance. There could be several other instances. For example, certain post-import conditions, an importer is not able to comply, he can go back and sort of reset the clock as far as his assessment was done and that was completed earlier. I think 18A is going to bring in a lot of relief for strategically making decisions that now turns out to be decisions made earlier turns out to be not in the best interests of importers or exporters. So this is definitely a welcome measure. A few safeguards are provided here. For example, the time limitations, the form, and the manner in which this revision is permitted will have to be prescribed. But the safety that is provided for in the law is that in case the revision is a downward revision, if it's a downward revision, the excess duty paid will be subject to review of unjust enrichment and the other conditions related to refund. But most importantly, the limitation that applies is not based on the date when the revision was made, but from the date when the original duty was paid that now gives rise to a refund.
So I'm so sorry to interrupt in between, but your screen is not visible, the PPT you have shared.
There is no PPT.
Oh, okay, fine. I'm so sorry.
All right. So when we look at another interesting amendment made is to do away with, to replace the settlement commission with a interim board for settlement that is to be constituted under 31A of Central Excise Act. Clearly, a swift move is being made here by the government to bring about a change in the settlement commission as far as customs demands are concerned. The interim board for settlement will be set up under the Central Excise Act 1944, which will also have responsibility in respect of settlement of all pending applications and matters to come up in the future. From 1/4/2025, this IBS will take over the responsibility of settlement of disputes. It will be manned by 3 commissioners who will review applications and dispose of those applications. With that, we've also touched upon the 31A proposed to be introduced in Central Excise so that the statute under which this IBS will be constituted is not customs law, but Central Excise law. But consider, friends, that this provision is going to make room for a fully now this when we say the board for settlement, we understand a certain degree of permanence. But if you say it's an interim board for settlement, does it mean that this is going to be a short-lived board, or it's going to continue to do its service in the years to come, is something for us to wait and watch. Now let's quickly jump straight into the amendments proposed in in GST law. Friends, if we look at some significant changes that are being talked about to come into effect very soon, we've seen that the requirement to comply with Input Service Distributor has been talked about a lot. I want to give this a few minutes to bring this to participants' attention. ISD registration is not mandatory from 1st April 2025. And before we jump into this topic, let's ask ourselves, what is this inward supply of services which for some reason the invoice cannot be directed to the branch that is consuming the services? Second, what is this service that is received, where the invoices are received at a central location and is not consumed by that central location to be distributed to the branches? I'll restate this for your consideration. Think of the inward supply of services that are delivered to the branches, distinct persons, but somehow the invoice cannot be issued to those branches. Friends, please bear in mind, it's not an instance of accounting hygiene or invoicing discipline. If the service is consumed by a branch, the invoice logically should go to the branch. But if someone were to say that, no, although the service is delivered to the branch, consumed by the branch, the invoice mysteriously cannot be sent to that branch. Now, it's one thing to say there's going to be centralized procurement. It's another thing to say centralized payment processing. We have to find inward supply of services that cannot be billed to the branch where the service is located. Secondly, let's also consider distribution of credit has its roots in dealer's invoice in central excise. Those who are interested to get some background, I'll encourage you to please read up about dealer's registration in central excise, the nature of that registration, and how it was operating as mutually exclusive from a manufacturing registration, a manufacturer's registration in central excise. It is either manufacturer or a dealer, but not both. Now we will come to GST law and look at this ISD registration. A place which is to be registered as an ISD location should not itself also be a fixed establishment, because if it is a fixed establishment, then it will be a location of supplier of services. If it's a location of supplier of services, then it will be a place of business attracting regular registration under 22. So I leave these 3 points for you to consider. Why do we need ISD registration? Please don't rush and get yourself ISD registered, because another registration will mean another area of compliance to add to with no incremental value. Now, if you see the amendment that is proposed in this finance bill is a matter of drafting cleanup. Previously, references to inward supplies attracting tax under 9394 were referred, and references to 53 and 54 IGST Act was omitted. That has now been inserted so that when ISD amended definition takes effect, then it will be including RCM liabilities also. Does it mean ISD location will also have to discharge RCM? No, an ISD incoming invoice will be received and distributed such that the branch receiving the distribution will not only receive credit distributed, but RCM liability to be discharged will also stand distributed. Keep that in mind when you get into the rest of ISD, because I think up to April 2025, ISD is going to occupy a lot of our reading material, access to conversations, discussions, debates, deliberations, and even some of the online content that we will get to read will sort of focus on ISD and its compliances. Moving on from there, we look at another interesting amendment that is to be brought in. It talks about a unique identification marking. We'll talk about this in detail when we get to 148A. That's a new section that is proposed to be inserted to make provision for this unique identification marking. What will it do? What will be its effects? Because this is traceable to the decision of the Council of track and trace. Government wants to track and trace movement of consignments to see how they can have even less government, but even more governance. When we look at some significant amendments, we've seen amendments being proposed to drop Section 12.4 and 13.4. What were these two provisions? They basically talked about time of supply in respect of vouchers. Friends, government has recently issued a circular explaining the treatment of vouchers. And I was very encouraged when I read this circular, because they talked about vouchers that represent stored fiat currency and vouchers that don't have stored fiat currency. Very quickly, I will tell you what it is and let you go through the circular and grasp the contours of how it applies. If you have to pay fiat currency, that is the legal tender, if you have to pay money to get a voucher, to get credit for it in an electronic form, then that is a stored currency. It's a form of money itself, because the definition of money says any instrument recognized by Reserve Bank of India. Which is a statute under which such digital currencies are recognized. That's the Payment and Settlement Systems Act 2007. So therefore, if it is stored value, then it is money. It is not voucher. But if it is value to use, that is, there is no stored value, you download an app, 50 rupees will be credited into your account. Money is, no one is increasing the money in circulation. They are offering something that will behave like money and be accepted as consideration. The third aspect I want to mention is when you look at store value to use, that is, where there is no fiat currency stored, it's only a value which you can use. Always look for, is the issuer the redeemer? What is the difference? The one who will give you the points, let's not call it 50 rupees because it tends to create in the mind, blur the lines as far as stored value and value to use. If it is 50 points, 1:1 or 1:0.5 as the redemption ratio, the one who credits those points to your account is that same person going to redeem it on a future occasion when you make a purchase. Here is a case which is called the issuer is the redeemer. The second one is the issuer is not the redeemer. You go and do something, you will earn some points from one entity and you are permitted to redeem it in a different entity. Now, how will the redeeming entity entertain this value to use? Because the money consideration to the redeeming entity will be paid eventually by the issuer of these points. I'll leave you with these thoughts. Please dive right into the circular issued by the government regarding vouchers. But the illuminating aspect of it is completely based on first principles of how stored value functions with value to use, and one is not, and both cannot be used interchangeably. The definition of voucher is also important to understand because it talks about voucher as an instrument with an obligation to be accepted as consideration. All very, very powerful, loaded expressions, deep with meaning and replete with a lot of jurisprudence on each of these expressions. So please be very, very careful. When you look at stored value, look for fiat currency that has been deposited. If it is, and is it being issued by a regulated entity? The next is when it is value to use, ask yourself whether the issuer is the redeemer or the redeemer is a different entity compared to the issuer. Moving on from there, we look at the amendment that is proposed to 17.5 to set right all the confusion ostensibly arising in Safari Retreats case. We had a conversation earlier, I think twice we had this conversation. Once on the Taxmann platform about the effects of Safari Retreats decision. But friends, please bear in mind, plant or machinery was disjointed and therefore Supreme Court had explained that they're not referring to one single subject matter, but they refer to two different subject matters. Interestingly, to bring to your attention, plant or machinery, the expression which resides in central GST law does not say so as far as three states I'm told. One is Rajasthan, J&K and Pondicherry. These three state legislations have always contained plant and machinery. They have never had plant or machinery. CGST and all other states and UT legislations contained plant or machinery. Today, amendment is proposed to give effect to it from 1st July 2017 as if there was never any such expression plant or machinery. Friends, please bear in mind, this amendment basically obliterates Safari Retreat decision. It does not even go back in time to the Safari of Orissa High Court. It goes back and obliterates this entire authoritative thinking that went behind rendering the decision both by the High Court and by Supreme Court. So there is this amendment, and taxpayers will need to be mindful that now there was the amendment makes it in such a way that there never was any plant or machinery. There was always and will be considered to have always been only plant and machinery as the expression in clause 17.5 in clause D of section 17.5. Moving on from there, we look at certain important aspects where giving effect to credit notes. Friends, section 34, we saw last year, in the previous amendment, a provision inserted in section 15.3b. 15.3b was inserted. Now section 34 also 34.2 also sees a replacement of the proviso. Friends, I was writing recently somewhere that credit notes will fall into disuse. People will stop issuing credit notes. Although business requires, accounting hygiene requires credit notes to be issued for two reasons. You will find that in this proposed amendment. First, credit notes, the tax adjustment of a credit note is permitted if and only if the counterparty has reversed the credit. We have circular very clearly stating, I think 212 talks about this credit availed in respect of the original invoice to the extent adjusted because of a credit note should be reversed. If it is not reversed, you get a CS certificate and what have you. But today, a proposal, the proviso to be inserted says that in order to get the tax adjustment, ensure that the counterparty has reversed credit. See, which one was a condition subsequent today has become a condition precedent. You issue credit note, you get the tax adjustment in this month's return that you file, and ensure a condition subsequent that the counterparty has reversed that credit. The counterparty may reverse the credit in the same month or the following month. But today what has happened is the tax adjustment itself is tied to a condition precedent that your counterparty should reverse the credit. How will we ensure a CS to behave like a CP is itself remarkable? But what is even more remarkable is the one seeking tax adjustment due to credit note is required to ensure that the incidence of tax is not passed on to any other person. So I'm telling you, friends, I'm greatly concerned about the proviso being proposed for the reason even exports where credit notes are issued may not be free from inquiry in respect of the tax adjustment. Now, why will there be any tax incidence on exports? Please bear in mind the definition of export of services is tied to repatriation of foreign currency as far as services are concerned. And as far as goods are concerned, Rule 96B makes it necessary to look at where refunds are claimed to examine subsequent repatriation. There is no question of not repatriating any foreign exchange and still not be affected by the GST implications of a credit note. What is industry able to do to address this? There are many, many instances where credit notes have to be issued. I'll place two aspects for your consideration. This comes out of a conversation, study group conversation we had here in Bangalore some time ago. A credit note cannot be routinely issued unless there is in fact a return of goods or the quality of the services or goods provided is deficient, and the other reasons are not fact-based, that is more error of issuing the invoice. Now, please examine goods can be returned. How can services be returned? Services cannot be returned. I gave you tax consultancy. You're not happy with it. You don't want to pay my invoice. If I issue a credit note for it, it means that you're returning back the tax consultancy. See, services don't get returned like goods. But then there are instances, FAQs, that credit notes can also be issued for services with the cancellation of contract, etc. But please consider. I'll give you an example in the context of goods to bring home this point as far as how it should be examined in the context of services. When goods are sent out, the goods may have a shelf life longer than November 30. The goods may have a shelf life longer than November 30. If you issue a credit note, you should issue a credit note before November 30. After November 30, if you have a return, what should be done? The counterparty must issue an invoice with the same HSN value, rate of tax, so on and so forth. What if the shelf life is less than November 30? Can you issue a credit note? Absolutely not. Just because statute permits November 30 as the drop dead date does not mean you can issue credit note unmindful of the reality of the product, because once a product passes its expiry date, its HSN classification cannot remain the same. Take all sorts of articles, especially items of food which is affixed with an MRP, items which of let's say medicines, variety of instances you will find in the context of goods where expiration of the product's life sooner than November 30 will itself act as a bar on issuing credit notes. Let's not just look at November 30 as the uh, all powerful date to issue credit note. Credit notes will come in for enormous scrutiny. Next, when someone issues credit note, who is responsible to demonstrate satisfaction of 15.3b, satisfaction of 13.2 proviso, 34.2 proviso? Who's going to prove all this? It's not revenue, it's taxpayer. Taxpayer has the burden to prove, because 103 of the old evidence law very clearly says information within the special knowledge of any person, burden of proof rests on that person to substantiate the position they're taking. And here is a case where credit note effectively means suo motu sanction of refund. So therefore, that aspect has come in for sharp consideration in the eyes of the government. So therefore, we have to be very careful. Take a simple instance: an invoice is issued and the whole invoice is found to be contain some error for some reason. The way to cancel an invoice, whether it's a e-invoice or a regular invoice, the approach is to issue a credit note to the full extent of the invoice. Having issued an invoice and a credit note, immediately, not more than the month in which the invoice and credit note came to be issued, another invoice must be issued. And this is where areas of review and verification will be taken up extensively to find out why is there an interval of time between credit note and the follow-up invoice. And if the follow-up invoice is obviously not the same value as the original invoice, that will come up for added scrutiny. Friends, please be mindful. It's not that credit note scrutiny is only limited to 65 or 67. Credit note scrutiny can even come up in 67, because 15.3b and 34.2 now says that it has to be established. Why will this not fit within the terms of a discrepancy in the return? Because there is no method by which prima facie satisfaction can be provided. Now we look at the IMS that was introduced on 1st November. IMS permits acceptance or rejection of credit notes by the counterparty. Keep credit notes pending is not permitted. And if the rejection is not done, it is deemed to be accepted. Can we say that that is sufficient? If that was sufficient, why do we have this proviso in 34.2? So credit notes needs deep understanding to examine the tax effect, because credit note having been issued, the counterparty has already adjusted it and paid the remainder of the invoice, but here the tax adjustment is still up for grabs until it is satisfactorily established. Two amendments in the context of appeal in the time that we have. I'll bring this to your consideration. When we have pre-deposit, if you look at the language, we've seen under 107.6, pre-deposit is a precondition to file appeal, because 107.6 begins with the expression no appeal. That means it's not like an appeal can be filed and then pre-deposit made. The language is the appeal is non-est if pre-deposit is not made. Today, there's a amendment proposed to 107.6 as well as 112.8 to say that where the demand is wholly for penalty, then 10% of such penalty will also be required to be deposited. Now, where will the penalty alone apply? Where will penalty alone apply? 122.1, 122 1A also, but we won't go into those things, because those persons who indulge in carousel trading and mischief, they are not to enjoy support and encouragement from any quarter of any of the professionals. So we let that be. Instances where penalties are on standalone basis imposed for taxpayers to litigate that they'll have to make a 10% pre-deposit of such penalty. Where tax and penalty, this is the old central excise provisions, where tax and penalty is imposed, that will remain under the main provision. The proviso only says. Now my question is, should pre-deposit of penalty be made in cash only, or can pre-deposit be made in credit? My view is that pre-deposit is not payment of the tax. If you see circular 178 para 6, it says penalty, late fee, interest, fines have to RCM have to be paid in cash ledger only and not through credit ledger. But all others can be paid through credit ledger. Therefore, once we call it pre-deposit, and pre-deposit does not have character of penalty or late fee or interest or deposit can be paid through credit ledger, which taxpayers need to be diligent about. Now we have this concern about how will persons charged with penalty, let's say the key management people in legal entities, if they have an incidence of penalty under 122(3), what will happen to their remedy for appeal? Today, temporary login credentials practice is in force, but it is very transient. It's usually for e-way bill interception, e-way bill discrepancies. There's an interception and there is a penalty imposed. To make online payments of those penalties, temporary login may be given. But today, if there are so many use cases for temporary login, and if there is a manager of an organization who's fastened with a penalty under 122(3), not only because the quantum is not substantial, but a principle itself that the person is not liable, he may want to agitate it, and he needs to now go through the motions of getting himself a temporary login. I would definitely like to see the government create a subset of registration which is only for purposes of unregistered persons, without forfeiting the character of an unregistered person. If a person were to engage on the platform, they should be allowed a system of getting a login credential that is not transient, that will stay for as long as the appeal is required, and even longer to get the refund of any pre-deposit paid. Next, the expression here we find in the proviso that is proposed, provided that in case of any order demanding penalty without involving demand of any tax, no appeal shall be filed against such order unless a sum equal to 10% of the said penalty has been paid by the appellant. What about fine? What about fine? Is fine penalty? Fine under 130 subsection 2, is it penalty? Answer is a vehement no, because it's a fine in lieu of confiscation. And that fine will be in addition to penalty under 122. So therefore, MOB 11 orders to be carried in appeal can be carried without any pre-deposit. Is this a slip? Is this going to be fixed in the next amendment that is to come in, similar to the ISD amendment of 5354? We don't know. But as it stands, no change as far as this provision is concerned. Penalty will continue to be agitated. Again, any appeal on late fee, no pre-deposit, because late fee is not penalty. If it is penalty, then it is not late fee. Similar amendment is proposed in 112(8), that is when tribunal appeals have to be filed. As far as the talking points are concerned, it's the same aspects under 112(8), but today when taxpayers have suffered an adverse order either in adjudication or in appeal, before Finance Number 2 Act 2025 proceeds further into and gets enacted, corresponding provisions in state legislation is also amended, no pre-deposit on penalty. But once this amendment is notified, from then onwards, pre-deposit will be required. Now let's look at what happens when there is an adverse order in appeal and taxpayer is hoping to carry the matter to tribunal. Tribunal is not yet formed. Circular 238 very clearly says that in para 4, that pre-deposit has to be paid along with an undertaking to keep recovery action under 79 at bay. So therefore, if once this amendment comes into effect, we're also hoping that the tribunal will be set up anytime soon. Government is working tirelessly to get that off the ground and implemented at the earliest. why, as things stand today, tribunal is not operational. If anyone has an adverse order, please expect that pre-deposit, after all, pre-deposit anticipating tribunal appeal is still only through the circular, not in the statute, because unless limitation starts, there's no need to make any pre-deposit, but circular seems to uh, impose pre-deposit pending to keep recovery action at bay. Taxpayers should also expect that even this proviso could get implemented through 79 and circular 238, because after all, the compliance with pre-deposit is in anticipation of what is going to happen. Once tribunal is set up, by which time the law will have got amended, so filing those appeals will require 10% penalty. Interesting is that if you look at the proviso to be inserted in 112.8, it talks about 10%, sum equal to 10% of the said penalty in addition to the amount payable under proviso to 1076. Now, if someone's going to tribunal and has never paid any penalty in first appeal because the amendment was not in effect, will they have to only pay 10% or 10 plus 10? Because it says in addition to the amount pay a bill under 1076 proviso, not paid. As the law then was, you did not pay any pre-deposit. But as the law now stands, once it is enacted, what about the penalty payable under one? My concern is that penalty cases will attract 20% penalty when you carry the matter to tribunal straight away, so that what was missed in 1076 is made up in 1128. Very interesting the way drafting has been done, and that's the beauty of the way the law gets, the policy decision gets translated into legislative language. Amendments propose insertion of new provisions to impose penalty in case of UIN non-compliance. Now we talk about 148A, very interesting 148A. Government has proposed this track and trace system. What government is trying to do is in 148, friends, I'm very keen to look at the placement of a section. Why is this unique this UIN being located in 148A and not elsewhere? Because clearly this is a provision regarding administration, and therefore it is going to be imposed in a very serious manner. What it requires is government is going to notify goods, persons, or class of persons. Goods will be notified, persons will be notified, class of persons will be notified who deal with such goods. It could be